Hello viewers, my name is Tokmo Gandiwa. Welcome again to Inflation Factors. Today I'm joined by economist Victor Boroma. Today we are mainly going to deep dive into the inflation situation in our country. We have seen an upward trend from the month of January to February, and we also have got some impacts that are contributing to this inflation due to the Ukrainian and Russian war that is currently happening. Welcome, Victor.
Thank you so much, Tokmo. Thank you so much to your viewers as well.
So, my first question to you is that can you kindly share your experience as an economist in Zimbabwe?
Okay, thank you so much for the question. Basically, I am not an economist by profession, as per se. I'm an economic analyst. So what basically motivated me to actually start, doing economic analysis? That in the local media space, sometimes you read articles, but you have got either side of the story. You have got either the black and the white, but you don't have objective analysis of probably economic trends and macroeconomic factors in the country and how they affect the common man. And at the same time, some of the debates that go on, especially on social media and other platforms, are too polarized. So you would want somehow an independent voice and be able to, contribute meaningfully to debate, be able to contribute as well to policy making, be of influence, to policy making and policy analysis. So that's what motivated me. In terms of experience, I think the media space is more or less opened. The coming in of the new government, I think in 2018, came in with different expectations and a totally different treatment, obviously, to journalists, analysts and other professionals that play a significant part in the economic fora. So it has been good, it has been eye-opening. It has actually managed to help me, connect, help me appeal and all that. So I think it has been a good experience so far.
Okay, thank you so much. So in 2021, since the beginning of the year up to the first half of the year, we have experienced a downward trend on inflation in numbers. They were dropping, but since the second half of 2021 to December, it continued to be an upward trend, right? But dramatically in January, we had a slow on inflation, which was mainly contributed to the holiday, which was the Christmas and everything. But in February, we have seen the inflation starting picking up again, back to 7.0% a month-on-month inflation. What does this mean to the developing country like Zimbabwe?
Okay, yeah. So obviously, we started a year on a good note because year-on-year inflation was more or less stagnant at around 61%. But as you highlighted, month-on-month inflation went up from around 5.43% to over 7%. So which is quite significant actually. But if we compare with the prior years, 2019 and 2020, it's relatively on the low side. But however, still, as long as you've got double digits annual inflation, you're still on the high side and it's not sustainable in terms of economic growth. Then in terms of what it means, it means that your local currency is continuously depreciating. It's continuously losing value. So what it means is that it becomes very difficult as an economy to build savings. That's number one. Then number two is there is continuous pressure on limited foreign currency resources, because as long as you've got high inflation in local currency, economic players have to find a stable currency in which they save in and be able to trade and plan in. So that means there is continuous pressure on limited, foreign currency that is available in the local market. Then number three, it also becomes, very difficult for local businesses, especially when you factor in exchange rate losses that happen because of the depreciating currency. So it becomes very difficult, for businesses to report. So that's why there is this talk about inflation adjustment and all that. So it's also a nightmare. Then lastly, if you look at the ordinary man, which is the household, there is continuous erosion of buying power. So the amount of goods and services probably that you need in a household that you could buy in the prior month and what you can buy, in the current month, obviously will be different without an adjustment in terms of income. It could be your salaries and wages. So it means that you have got a continuous, a maintenance of, or even actually an increase in poverty cases because of that growth in inflation. So it's something that has to be managed, and it's not sustainable for economic growth.
Okay. So for December, the push factors for inflation were mainly imported.
Yeah.
What about for February? What are the main push factors for this inflation?
Okay. So when you look at February, there are a number of factors. So I would say when news broke out that Russia was, on the verge of attacking Ukraine, so it has got an impact. And why do I say so? It comes from three fronts. The first one, the European Union and obviously United States, started to discuss a package of sanctions. So those sanctions obviously affect international trade. Then that's number one. Then number two, obviously you have got an effect where Russia and Ukraine have to build stocks for some strategic commodities. So obviously they look into the future. Obviously they need more oil, they will need more wheat, they will need more of their homegrown commodities in order to obviously support the war. So once the news broke out, it also brought about some speculation and a rush towards the commodities that, towards probably the alternative suppliers of oil. It could be barley, it could be of wheat. So that also brings in imported inflation, which is more or less from the global front. But locally, we still have got our own issues because in February, the price of fuel went up from $38 to around $48. So that also has got an impact to inflation. Then, in addition, you've got the usual money supply growth. As long as you've got money supply growth, you would also expect a run on the foreign currency which is available. And you look at the delays that we had, obviously, towards the festive season in terms of the auction. So the reopening of the economy after the festive period brings in, pressure on foreign currency because businesses have to restock. So that also brings in an increase in price of basic goods and services on the local market.
Okay. So one would argue that since Ukraine and Russia are the main suppliers of wheat and oil, one would argue in Zimbabwe that we don't import from Russia, we don't import oil from Russia, but neither way we import from South Africa. So it has the tension between these two countries has no direct impact on Zimbabwe. What is your note on that one?
I wouldn't agree there to say it has no direct impact. Because last year alone, Zimbabwe imported 45% of its wheat from Russia. Why? Even though our production as a country for wheat last year went up, we still need imported factor of wheat for about 25 to 35% in order to blend with the local flour, so that you've got the self-raising aspect that you've got for wheat. So local bakers have got to import wheat. So last year alone we imported about 40 to 45% of our wheat requirements from Russia. But remember, we live in a global village where a key producer of a commodity, which is Russia, which is probably the fourth or the fifth largest producer of crude oil, if it has got supply constraints in any way, it does affect the price from the alternative suppliers. Because what happens is there's a scramble towards those who can be able to supply that particular commodity. So it pushes the price up. So whenever there is an increase in demand due to any constraint in supply, prices go up. So that's number one. That's how it affects Zimbabwe. Then number two, remember we spoke about sanctions to Russia, Belarus, and the companies that obviously are involved in the production of oil, such as Gazprom and Lukoil. Remember, Zimbabwe is under United States sanctions, so it also impacts the ability to be able to procure, petroleum or liquid fuels directly from companies in Russia. So what happens now is we have got commodity brokers in between that that buy the commodity, and we can be able to buy from those. So that's where Glencore come in and Trafigura come in. So as long as there is a gap, or as long as there is a bottleneck, those sanctions obviously affect in terms of financial transactions. So if there is a bottleneck, and if there is a challenge in terms of paying for the commodity for these brokers, it does affect us. So that's how we have been affected by the war in Ukraine.
Okay. So earlier on you mentioned about money supply growth.
Yeah.
Can you enlighten us? Can you make our viewers appreciate what do you mean by money supply growth?
Okay.
Because not everyone understands.
True. Okay. So when we talk about money in an economy, you have got two sides. You have got the physical notes and coins. Then you also have got the virtual or electronic money, as it were, that we use in Zimbabwe. So remember, in Zimbabwe, 97% of our transactions are digital. And when I say digital, it means you use plastic money, you buy your commodities via ATM cards, you pay using mobile money through other facilities such as Zipit or online transactions. Those are the major payment platforms that dominate the current payment system in Zimbabwe. So when we look at money supply, this is the amount of currency that is circulating in an economy. It could be in physical or electronic form. So what now happens is it can be divided into various forms, which can be broad money, which can be other electronic deposits with the central bank. But in generic terms, money supply looks at the printing effect, which is called quantitative easing in economics, which is the function or the core function of the central bank, which is to print money in line with economic growth. However, if you have got a situation where money is printed at a rate which is not in tandem or which is not in sync with economic growth, then that money supply growth will lead to inflation. Because remember, when money grows, there is obviously a run on the goods that are available in the market. So increase in demand pushes up prices. So the increase in money supply is more or less the increase in the deposits that are in local banks and that are held by the Reserve Bank. But in effect, they increase the amount of money that circulates in the economy. That pushes obviously and increases the demand for foreign currency on the local market. So that's probably what money supply refers.
Okay, thank you, Montatron. So inflation, how has it have an impact on our economy?
Okay. So inflation has been, I would say, one of the worst factors to affect the Zimbabwean economy. Why do I say so? I've touched briefly on some of these aspects initially. The first one is that it erodes confidence in the local currency. So no one would want to hold on to the local currency unnecessarily. So if you get paid in a local currency, you just keep only what you need to use or what you need to buy with. Otherwise, you have to go onto the parallel market or the formal market to look for foreign currency. So there is erosion of confidence, public confidence in a local currency. That's number one. Then number two, high levels of inflation make it difficult to plan. Because if economic agents have to plan, it could be employees, it could be businesses, it could be exporters. Any player in an economy has to plan to say, this is what we anticipate to have, this is the amount of stock that we need to buy, this is the amount of investment, or this is the level of investment that we need to do. So that planning is made difficult if you've got high levels of inflation, because the amount of goods and services that you can be able to buy for a unit of currency today is not the same as that you can be able to buy 4 or 5 months later because of inflation. Then number 3, it wipes away savings. So if you have got savings, say for example, in the beginning of at the beginning of 2020, you had 1 million Zimbabwean dollars sitting in your in your local account. Imagine what it is worth now. So that means it's very difficult to be able to build savings as long as you've got high levels of inflation. Then it also erodes fixed income. You talk of your pension payments, they are affected. So in a way, you have got high levels of poverty for all those that rely on pension income. Then lastly, which is the greatest impact to an economy. Remember, an economy grows via consumption. So if you've got high levels of inflation, it affects disposable income. So if your disposable income is affected, or if it declines, it affects the amount of goods and services that you can be able to consume in a certain month, or that you can be able to buy. So if you've got erosion of consumer confidence, erosion of buying power, and if there's a decline in consumption, it affects economic growth, and it reduces obviously economic output. So that is the major 5 factors in terms of the impact of inflation to the local economy.
So let's go to the auction system.
Yes.
The auction system was once opened by Dr. Bon, and dramatically it increased inflation.
Yes.
Then the only solution was to close it. Then he closed it. Then it was reopened again. And we are seeing inflation picking up. But that's not my area. I want to come to this point. There is a gap between the parallel market and the official exchange rate. So how does this gap contribute to the inflation?
Okay. All right. So if you look at the intention, when the auction system was introduced, it was introduced in order to bring efficiency on the foreign exchange market. So when you talk of bringing in efficiency on the foreign exchange market, in other words, it's supposed to be a price discovery mechanism. So a price discovery mechanism allows the holders of foreign currency to be able to trade, on a free platform with those who want foreign currency. But however, it's no longer, and probably we can actually argue that it was never, a free market price discovery. It's more or less an allocation platform where foreign currency is allocated by the Reserve Bank. And in a very big way, the exchange rate is manipulated. And the holders of foreign currency know that they do not get a fair value if they sell their foreign currency on the auction market. So what it does now is that the gap or the premium between the formal auction rate and the parallel market rate keeps growing. So as long as that rate keeps growing, it means that, as I highlighted earlier on, as soon as you get your income in local currency, whether they use the formal auction rate or they use the parallel market rate, as long as it's in local currency, you have to change it to foreign currency in order to preserve value. So that persistent pressure on foreign currency is what keeps inflation going up. Then number 2, because there is no confidence on the auction system itself, all the traders in the local market follow the parallel market exchange rate. So they price their goods using the parallel market exchange rate. So any momentum, any instability or any increase in terms of the rate itself on the parallel market exchange rate directly translates to increase in prices, instant, on the local goods and services. So that's how inflation is directly linked onto the parallel market. So as long as you do not have efficiency in terms of the pricing of foreign currency on the formal market, you continuously have pressure on the parallel market, and that obviously strokes and triggers an increase in inflation, and it's unending. That's the reason why it's very important to have an efficient foreign exchange market.
Reserve Bank and the Treasury in the prior said anyone in the public can have an access of $50 US through the Beirut exchange.
Yes.
And is it not increasing the pressure on the foreign currency? That's number one. Number two, recently they've changed their system to just allow for the elderly people to access those $50. But we have seen a manipulation of it by the money changers in the street, taking their old age ID, their parents at home, their IDs, to collect those $50. Is not also increasing pressure on the foreign currency?
Okay. To say it increases pressure, I wouldn't say it increases pressure, because the amount of foreign currency that is needed is directly correlated to the amount of domestic currency which is printed, and our needs to be able to import or probably sell in foreign currency. So I wouldn't say the Beirut changes or the system that is used to fund it is what increases pressure on foreign currency. But what I would say is, it's not the role of the central bank, it is not the role of the government to supply foreign currency in an economy. That is not their role. The foreign currency which the government gets from tax revenues should be used on public services. It should not be used to procure or to supply foreign currency to the Beirut change. Then, similarly, the foreign currency that is received through surrender requirements by the central bank should be used as import cover, and should be used in order to be able to fund or pay for foreign obligations of the state. So it is not the duty of the central bank to supply foreign currency to Beirut change houses. The reason why the central bank has to take that particular role or function is because it knows that on the other hand, it has got a role in soft pegging the formal exchange rate. That's the reason why they have to supply Beirut change houses. In an ordinary economy where there is free market price discovery for foreign currency, you can walk into the Beirut change, sell your $50 for local currency. That's how Beirut change houses make money. They make money through the premium and the commission they get in buying and selling foreign currency, not to get foreign currency from the government or from the central bank. So that particular system where Beirut change houses have to be supplied foreign currency from the government or the central bank is what aids corruption, because there are loopholes in that particular system. And like you highlighted, parallel market dealers take advantage. Those that are privileged take advantage. Those who are politically exposed take advantage. That is not the way foreign currency should be traded in an economy.
Okay, so going forward, we had a 22 budget which was published last year, and so to say, Minister of Finance pegged this budget with an official rate of 130.
Yes.
But as of today, it has surpassed 130.
Yes.
So, and also they are saying we are going to maintain a 25 to 35% inflation, annual inflation rate by end of year. Does this have an impact on our economy and inflation statistics?
So obviously, first things first, the 25 to 35% is not realistic. We started the year at 61%. We have already gone past 66%, and we have got these external pressures, and we still have got our money supply growth, which has not been tamed. So it's not even realistic to expect inflation to be below 90% by year end. So that's the first thing. Then secondly, the budget was based on a rate of 130. We've gone past that. We are now officially the soft pegged rate is at 138%. So what it means is that as long as you have got pressure on public expenditure, you would expect obviously the finance minister to come back and have a supplementary budget. Otherwise, the budgeted amounts will not be able to cater for the expenditure in public service, outlays that were allocated votes in November and December of 2021. So obviously we definitely expect a supplementary budget this year. Then obviously in terms of the effects obviously of missing those inflation targets, it does dent in terms of confidence. If you set a figure for annual inflation which is too low, because what it speaks to the market, or what it says to the market, is that the government always sets a figure which is too low, which they are not able to meet. So players in the economy have to rely on alternative sources of information in order to plan. So it dents public confidence in the central bank and in the treasury.
Okay, so coming to this current month of March, what would be the push factors of inflation in this current month, and what numbers are you projecting toward our inflation figures?
All right. So the major push factors, like we highlighted earlier on, the geopolitical events that are happening in Ukraine in terms of the war. Russia and Ukraine are key producers of commodities such as wheat, oil, and barley, and sunflower oil. So what happens is when you've got a war, as the situation is at the moment, there has been a rally in terms of the price for fuel. So that affects the Zimbabwean economy, and that is a factor in terms of the increase in the price of commodities and services on the market, because fuel is a key input in production, so it leads to an increase in price. Then obviously, if you've actually seen, the price of wheat has gone up from around 595 per ton to around 680, 685 now, because of the events in Ukraine. So that increase in terms of wheat also pushes up the price of bread and other commodities and products that are made from wheat, such as biscuits. Then number three, because there is pressure on alternative commodities that can replace wheat in production, such as soy, the price of cooking oil, and also coming in from sunflower oil, the price of cooking oil has also gone up on the global market. So that will be a push factor in terms of inflation locally. Then another push factor is also the issue of money supply that we were discussing. We still have money supply growth which is not in tandem with economic growth. It could be in quarterly terms or in yearly terms. So that obviously will lead to an increase in inflation. Then we have also seen an adjustment in terms of civil service salaries. So that will also put pressure on the limited foreign currency which is available on the market. Then in terms of forecast, obviously I expect annual inflation to go past 75% for March this year. And in terms of month-on-month inflation, it might be just below 10%. It's not going to be double digit, but probably 8 to around 8.5%, which will feed to around 75% in terms of annual inflation. That's my expectation or forecast in terms of inflation for March.
Before the end of Q2 for this year, having a single digit on month, or having a double digit on month.
All right. So if there is no peace in terms of a peace plan which is agreeable between Russia and Ukraine, you have obviously pressure in terms of food on the global market, and the rally in terms of oil will continuously go up because we've already gone past $20 per barrel in terms of oil. So that will obviously continue to create pressure in terms of imported inflation. Then secondly, if we do not have any reforms on the auction platform, And if we still have that high level of premium between the formal rate and the parallel market rate, and increase in terms of money supply, those are the three key factors in terms of inflation, then it means that we will definitely go past 10% in terms of month-on-month inflation for the second quarter. So it actually rests on those three key factors. If there is management of those on those three issues, then inflation will obviously drop to below 5% as we head towards the end of last year.
Okay. So basically, for the annual inflation, what do we need to do to have a single digit inflation for our annual inflation?
For annual inflation, all right. What we need to do, number one, is to reform our foreign exchange market. We need a managed foreign exchange platform, or at least an auction platform based on free market price discovery, to manage pressure on foreign currency. That's number one, so that we can be able to crowd in all the private holders or all the independent holders of foreign currency onto the formal market. Then number two, we also need prudence in terms of money supply growth. But unfortunately, we have already entered in an election season, so I do not see money supply growth being managed. We will continuously have the state funding agricultural inputs and other subsidies. It could be to pump or increase production of cotton, gold, tobacco, and other things that border on quasi-fiscal operations by the central bank. So the number two is the issue of managing the money supply. Then number three, obviously you would also need to have reforms on the overall foreign exchange regulations, so that local investors and international investors can be able to use the formal market to be able to remit dividends or to move capital in and out of the local market, such that we do not have pressure on the parallel market. So as long as we do not have pressure on the parallel market and there is stability on the parallel market, because the parallel market rate is what is used by local trader, then at least we can be able to have stable annual inflation.
Okay, thank you. Thank you, Victor Boroma. That's all from us. My name once again is Tukumo Gandio. Today we had economic analyst Victor Boroma. Thank you, viewers. Remember to like us on our Twitter account. Follow us, it's Tambarara Live, and also Twitter account. I think it's Victor Boroma.
Yes,
on Twitter. Thank you, viewers, once again.
Thank you so much.